Hi there, welcome one and all to another live webinar with Phillip Futures. This is your MC for today. My name is Sri. With us, someone else who's in the studio today is none other than our investment analyst, Benjamin Liu. And today we'll be discussing a topic that we have not covered very frequently. It is on exploring trading opportunities for base metals in 2020. All right, this is a two-part series, and today is the first part. And because it's the first part of the two-parter, we're going to be covering more of an overview of base metals. He'll be sharing more details about how you can explore exchange-traded base metal futures, as well as the applications of base metals in the financial markets, as well as key product developments in the future space for base metals. And I shared before, the gentleman in the studio with us today is Benjamin Liu. He's our investment analyst. He specializes in commodities, including gold and crude oil. And today he'll be talking about base metals. Ben, if you're all set and your mic is rigged up.
Yes, hi Sri. Thanks for the introduction. Hi guys, can you hear me? Sri, can you hear me?
Yes, I can hear you loud and clear.
Okay, so I'll just take it over from here. Thanks, man. Yep.
All right,
So,
no problem.
Yep. So very good evening, everyone. Once again, thank you for joining us on this webinar. So this will be part one of our two-part series. We'll be exploring the non-ferrous marketplace and basically on potential trading opportunities for 2020. In the first part of the webinar, is basically a base metal 101. We will cover the basic functions of base metal, the common applications in the commercial world. I'd like you guys to also take a look at the different client segments that are trading in the non-ferrous market. And finally, before we can actually answer the fundamental question, how can we, individuals or firms alike, get started in the non-ferrous market? So without further ado, let's get started, and I hope you have some good takeaways after today. So before we begin, we have a disclaimer. So this, as every compliance department, we need to share this before the presentation starts proper. Do note that the content is an expression of belief with ample research and analysis done by myself. In a nutshell, for clarity, please feel free to contact me if you have any queries on the subject matter at hand. Today's session, we will cover 4 segments, which will take approximately 50 minutes before we move into 10 minutes of Q&A. There will be 4 segments. The first will be understanding metals. Basically, what's the difference between ferrous and non-ferrous? What are the 6 types of base metals and the common applications? Why should we actually mitigate price exposures through the futures market? And what is an example? I'll give you an example of vanilla hedging. Part 2 will be the non-ferrous marketplace. For this, we'll touch more on price discovery, the different channels that traders will adopt to participate in base metal trading. We will of course look at the different financial instruments, probably do a brief comparison between its trading performance, and we have a brief introduction into the schematics of exchange traded derivatives. The third portion, we'll go into market performance. I'll share briefly on market fundamentals and key indicators that will affect price action for base metals. We'll then do a bit of technical analysis just to share how speculative activities are carried out on exchange traded derivatives. On the last portion, more on product development, I will go into wrap up the webinar with a basic introduction on the latest products in base metals, how investors can get started, and the Q&A session will follow thereafter. Feel free to actually type your questions in the chat. I'll do my best to answer them during after the post-webinar, or even if I don't get to answer a webinar because of time constraints, I'll just reply them via email. Yep. Okay. So just a brief introduction into metals for some of our viewers who are not as familiar. So if you look at the world of metals, there are actually 2 distinct categorizations. So you have ferrous and of course non-ferrous. The main difference, or rather the primary difference, is just that ferrous contains iron while non-ferrous doesn't. So ferrous metal, for example, you have an iron ore, which after you refine it, it becomes steel. So of course there are alloy steel, carbon steel, cast iron. So all these are staple in the construction industry. They're used in maybe skyscrapers, building, shipping containers, industry pipings, automobiles are some examples. So for ferrous derivatives, there are some examples like iron ore futures, steel rebar, hot rail steel derivatives that are in the marketplace. But if you look closer at our subject matter for today, non-ferrous metal, you will see the common 6, which is copper, aluminium, zinc, lead, tin, nickel. There's of course precious metals, which is gold, silver, which are categorized as non-ferrous. But this time around, we'll look at base. So the difference is that this for base metal, there's no iron content. So they have a higher resistance to rust and corrosion. So it's ideal for a lot of also construction or industrial materials like pipes, roofings, etc. Why should we actually pay attention to the common application? Because this is actually has a very strong correlation to the price action because of its commercial application. So you'll notice for base metals, right, it's actually very important for traders to pay attention to key economic indicators like PMI, transportation, construction, even GDP globally. So you need to look at the major markets, and especially as we move through the presentation, you realize that it's a Chinese story and that China has played a very big part to the price action because of its commercial industrial utility for the underlying asset classes. So for example, copper is widely used in the electrical industry because of its high conductivity for electricity and heat. So you see sheet roofing, wirings and bearings. Whereas for aluminum, it's widely used in maybe the aircraft, food packaging industry because of its chemical properties, lightweight and soft. Whereas for zinc, it's actually used for galvanizing to prevent rusting for iron and steel. So you will see it as a lot in alloys as well, where they combine zinc and copper, where the end result is actually automotive and electrical components. So you will see a repetition. Most of them are used in electrical industry, building construction, automotive. So hence the indicators of PMIs actually heavily impact the price action. So it's important to know all this due to its correlation with price action. Yeah. So if we look next at market participants in the non-ferrous market. So there are actually two primary client segments that trade base metals in the commodity markets. You will have the commodity traders who come from the miners, who might be miners, commodity trading houses, smelting plants or commercial users. They primarily engage the futures market or OTC or forward market to hedge their physical price exposures due to their primary business activities. The second client segment that you will notice is speculative market forces. These might be funds, proprietary traders, retail investors who are looking to trade base metal as an asset class. So this group of clients are actually making a speculative play on prices. So primarily these two. This is what you see in the ferrous market. So an example for those of you who are in the commercial or physical trading houses. So actually, why hedge base metals? Why mitigate your price exposure? Now, these are some of the key points that I've summarized to help you out. So hedging actually allows you to mitigate commodity price risk and fluctuations. Through participation in the futures market, it actually helps you to discover prices, mitigate price exposures against the unexpected increases in commodity prices. We have seen in COVID-19 where some might say it's a V-shaped recovery. It's the same thing. So the volatility is there in prices. So with that in mind, right, with hedging in mind, it allows producers and buyers to actually protect yourself from these fluctuations as you can guarantee a specific price for the commodity. And in that case, better manage market risk, where you can actually lock in a worst case scenario price to actually limit your potential losses. So futures and options, exchange traded derivatives, are actually two of the financial instruments commonly used to hedge against flat price risk. Next, you can, and also of course there's geopolitical and economic uncertainties, as I mentioned in COVID-19. All this actually has a big impact on your balance sheet as a commercial player in the base metal value chain if you actually go in naked, which is you don't hedge. So, okay, just an example for some of our clients, right, viewers. So how do you actually hedge a physical trade? So an example is a commercial agreement. So on June 20th, a mid-sized commodity trading firm agrees to purchase 40 tons of cathodes from a commodity smelter on September 20th, the delivery date. So on 2nd June, the trader buys one lot of LME 3-month rolling forward copper, which the size is a 25 ton contract specs, and 3 lots of Hong Kong Exchange London Mini, 5 tons. So with that being entered, the price is 6,500. Hit it electronically. You get the initial margin. The outlay is this $17,006. Sorry, excuse me. So in Hong Kong Exchange, it's 2,220 for each contract. That is the initial margin required by the exchange. Whereas for LME, a rolling forward is 10,400. So on delivery due date in September 20, 3 months later, so commodity price have increased to 6,600. So we make assumption that both parties have agreed to peg the transaction on the average of this September month contract. So on July 20, the trader will close off his position. Actually, on September 20, trader will close off his position, and this is his current P&L on the futures market, which is $4,000 in profit. However, so by hedging, he is able to use the profits on the futures market to actually mitigate what would have been losses on the physical price exposure as corporate prices has went up. So hedging is a way to offset the losses. Of course, we have not factored in the broker charge and the exchange fees, but that's largely very minimal as compared to the losses in the physical price action. Okay, next we will move on to basically the non-ferrous marketplace. How can actually traders discover price for base metals? So there are actually three primary methods. You can always engage in a spot market or OTC forwards or via trading futures and options. The spot market is very much for the commercial players, as you have to take inventory, you have to take delivery. So not so much if you're a speculator, it's not the best option, or rather it's an option that is not available. On OTC forward, it's an option. However, there's a counterparty risk as compared to trading futures and options on exchange traded derivatives. So for ETDs, there are actually four main exchanges that offers base metals, futures and options for market participants. We have, of course, the oldest, the London Metal Exchange, the world center for industrial metals trading. So market participants are able to trade ferrous and non-ferrous through spot and OTC contracts. Next, we have Hong Kong Exchange, which offers trading access to ferrous metal, iron ore, and non-ferrous base metals, both denominated in USD and CNH. Third, we have COMEX, which has copper and aluminium, and fourth, we have Shanghai, which has 6 base metal futures contract and has a large base of retail participants. So you can see over here, right, there's 4 of them. So for example, in COMEX, it's a large futures market. For London Metal Exchange, there's actually a spot and actually a futures market, and also actually spot OTC and actually forwards. Hong Kong, it's primarily futures, USD and both CNH denominated. Shanghai, which has futures and spot, however, it's actually rather closed to actually domestic market participants. It's not really available for global markets and overseas investors. So here's actually an example that I've actually put up price chart as a comparison actually for the LME 3-month copper contract against the Hong Kong Exchange USD mini copper. So as we see over here, both contracts are actually highly correlated. That is because the Hong Kong Exchange contract, which is a mini variation, takes reference on settlement prices from the LME 3rd Wednesday contract on the spot month. So both contracts actually has the same underlying asset. That's why you see high correlation. The contract ratio between both contracts is 5:1. So the LME contract is at 25 tons, whereas the Hong Kong Exchange contract is at 5 tons. So you can see over here, sometimes there's a little tear in the spreads. Actually, this is the difference of the spread difference that we've taken out from Bloomberg. You will notice that most of these points, right, are mean reverting. So it shows that market participants, right, can actually engage in arbitraging or even spread trading when trading intercommodity spreads for these contracts, as both contracts are highly correlated and tends to revert back into the mean. So this might be another trading strategy that one might adopt. But however, we will cover this in more detail, right, in the part 2 of the series, where we talk more about trading strategies. The only key difference I think one should realize of this contract is that the Hong Kong Exchange contract is a monthly cash settled contract, whereas the LME 3-month contract is a rolling forward. It's a rolling forward with prompt dates and physical delivery. You have to take note of this. So next, right, we'll talk a bit about the SHFE LME contract. So we'll notice that actually both contracts, right, they move in tandem. You can see as in red is the SHFE copper futures, whereas blue is the Hong Kong Exchange London Mini copper futures. So I've also put up, right, the Caixin manufacturing PMI indicator. So you will notice a very strong correlation when the PMI start to drop post-COVID. During COVID situation, you notice a sharp drop in industrial metals. Now, this is also because there's a very strong historical correlation, right, with the Chinese economic indicators and the prices of base metals. So that's because, of course, China imports actually more than 40, accounts for 40 or 50% of the base metal imports. You will notice it especially in aluminium and copper. This is actually a chart, a copper chart. So if you look carefully at the spreads as well, sometimes you see the occasional flips in prices, and this might also reflect as an opportunity for the different market participants. Next, we will look at the LME 3-month and aluminium and the COMEX aluminium. So you can see as well, both contracts are relatively it's not really that correlated for this portion. However, you will see that actually the LME is actually denominated in the contract. The difference is that LME is in weight in tons, but COMEX is actually in ounce. So most of the participation still comes from the LME, as LME is the world center for pricing. For COMEX, I think it's still more domestic for aluminium, and the liquidity is, of course, not as fantastic as LME. Okay, if we look at SHFE, just a minute, sorry. If you look at SHFE and the Hong Kong Exchange London Mini Aluminium Futures, you will largely see the same price trend correlation. The movement is largely similar, whereas we see the sharp drop in February. As I mentioned before, that is also due to the dependency on the Chinese economy, where, as I mentioned, China actually buys 40 to 50% of the world's raw aluminium. The LME aluminium, I think, is one of the most liquid contract on its exchange. I think the spreads are extremely tight. Traders get to benefit from deep order book and a very long forward curve. So in the Hong Kong Exchange London, which actually tracks that benchmark, I think it gives you a very good opportunity to start in something smaller if you wish to avoid forwards and go into like futures contract, which is a tad easier to understand. So next we will look a bit at zinc, which largely shows the same picture. If you notice, right, that as I mentioned, all of the Hong Kong exchange contracts actually tracks the LME benchmark, as the underlying asset is similar, and they take reference from the official settlement price. But I think what's important to note, right, from this example, which has tracked maybe about 3 months, right, is that it's largely mean reverting. It goes back to the center at the same time. There are some flips in the prices, but it goes back. So this might be an opportunity for traders, right, who wish to take advantage of the market inefficiencies, price inefficiencies, or differences in market participation. So for SHFE against the Hong Kong Exchange and zinc futures, it was largely the same pictures. The spread might widen a bit, but it then goes back again if you notice. So you can see over here, and it's also relatively all base metals are showing actually the same picture. Whereas it goes back after the weakening of PMIs, right, it does constitute a sharp drop in the price point. So actually, how can traders get access to exchange traded derivatives? So there are several methods, of course, I can show you. We can talk about the LME first. So there is the LME 3-month copper or LME 3-month aluminium. So I've actually put up just 2 contracts, right, to make it easier for you to understand, as there are more than 6 base metals. Basically, the contract unit is 25 metric tons. For the LME, is physically settled. It's actually a forward contract. It's in USD. The minimum tick value is 50 cents per metric ton. So if you were to enter into a contract, right, if it moves by a tick, which is 50 cents, your total profit and loss is actually $12.50. The contract period is up to 3 months. Initial margin for copper is 10,400, and for aluminum is about 2,460. I think this might not be accurate. Let me just check again. It's mostly it's a forward contract actually, so it works a bit different from the futures contract. If you wish to know more about LME, maybe drop me an email or text. I'll just respond from there, because I think we need more time to explain on this. But if you look at, for example, the Hong Kong Exchange USD London Metal Mini Futures, this is more conventional. So this, as what I said, is 1/5 the size. It's 5 metric tons. It is cash settled. is denominated in USD. It has the same tick value. The profit and loss is divided by 5, which is 250. So this is a monthly cash settle contract. If you let it float into expiry, you need not worry about physical delivery. It will just be cash settled. So the initial margin is as follows: 2,221, aluminium 566, and zinc is about 863. So why actually ETDs instead of forwards? Because you know that in the non-ferrous marketplace, there are also both futures and forward. Now, futures, I think, is standardized contracts, whereas forwards are customized between where two parties can actually negotiate and trade privately over the counter. So the key difference between futures and forwards, I think one must understand, is that futures are standardized, forwards are changeable. For futures, it's traded over the exchange. It limits market and credit risk. Forwards, on the other hand, though flexible, is over the counter and has higher market and credit risk. And settlement prices for futures are fixed, whereas settlement prices for forwards are agreed personally. So you will notice that, for example, price action, if you trade in futures, right? Futures are always the first responders instead of the ETF or maybe in the other markets. You get a direct play on the prices. If you're a pure speculator, right, it's just market-based considerations while trading ETDs. Execution cost is affordable and the fee structures are very transparent. You can get it off the exchange, get it off the website. It's leverage trading. You can get capital efficiencies. There's a diverse base of clients, as I spoke. There's from retail to proprietary traders to funds and even through commercial clients who are looking to hedge. There are counterparty risk. You get clearinghouse safeguards to actually prevent that, and ease of access, close to about 24 hours of trading per day. Now we will look more at the market performance for base metals. Okay, so I've put out the chart, right, that actually has the market performance for copper futures to take a close look at market fundamentals. So we can see over here, we can see that the prices were predominantly quite stagnant. I think metals before in 2019, actually they've been actually quite resilient, but we see the sharp drop in 2020 that actually due to the coronavirus. So one reason why I think metals has been surprisingly resilient is due to the risk sentiment. Although the China, which has actually saw a sharp recovery in the PMI, they are actually one of the most or single most important source of demand for industrial metal. As I mentioned, China buys 40 to 50% of the world's copper, aluminium, and steel, and for iron ore is more than two-thirds actually. So we noticed that besides the portion where the PMIs actually saw a recovery, what we saw was that there was a coronavirus-related supply shock. For example, in Peru, in Zambia, and actually South Africa, some of the mines actually were halted production, especially in Chile as well. So this is because due to the coronavirus outbreak. So even mining companies, due to the slower and economic landscape, they are actually putting off investments in the new mining operations. So all this has helped to actually build a recovery, as you see in prices. So the question is it sustainable for copper? What we notice is that over the past 10-15 years, industrial metals has always shown a very high correlation with Chinese growth. So on the demand portion, I guess we have to look at China. We have to look at the COVID situation, how it actually turns out, especially in the east. So I don't say demand in the east and actually production more on the west, South America. In the long run, I think that the copper prices, might be a little flat, but for now at least, we see that prices is likely to stabilize. As industries get restarted. I think if for those who are trading off headlines, you want to be careful on the disruptions in copper mining. All these are likely to remain supportive for copper in the short term. So I've summarized some actually key points. I think some things that you want to look at when trading copper. As you see, production, right, I've lifted it off LME. Mine production, you can see Chile, Peru, actually China actually accounts, Latin America especially, accounts for most of the production. That is why you see the supply shock actually helps to boost prices, keep it supportive. Whereas copper consumption by region, you see, is still largely Asian. And even the consumption by industry is all construction, industrial, transportation, infrastructure. So this is something that you want to really pay close attention to. As I mentioned, China imports is really a Chinese story. So the Chinese economic indicators, stockpile levels actually will impact price action. For market supply, you want to take a look at Peru, South Africa, and Zambia, and the coronavirus. For now, I think the inventory levels support a view of the very fundamental tight market, despite the weak projection on growth rates. This is something that you want to take a look. A few things that we look at as well to help us to gauge the performance for copper. You can look at the Commitment of Traders report on the LME website. It is a weekly report. You can look at copper data and reports. We get it off Reuters. Economic indicators, I think, is free for all. You get it. News-driven headlines, macroeconomic factors, geopolitical risks. All these are actually, it plays a part in copper prices. Yep. Okay. So if we look at aluminium, for example, so largely, as I said, it's the same story. I think I think in 2019, for example, one of the reasons where we saw was that political tensions actually escalated during the year. There was the impact of the US-China trade tariffs. This will actually play a huge part in aluminium prices. So overall, I think demand was impacted by weakness in the automotive, construction, in the construction sectors. So I think that kept aluminium prices a little soft, for 2019. But as we moved on to 2020, this portion is largely due to COVID, weak PMI data, drop in Chinese purchases, all the closure of the borders and everything. That's primarily the circuit breaker. And of course, now we see largely like copper, right? There's the recovery in the Chinese economic indicators that has actually pushed prices up. So in 2020, some are asking actually what next. I think the price look actually is not very inspiring. Most experts or industry experts are saying that actually global demand looks to be quite flat due to the upturn of global supply over the last few years. If we look at it, right, you will notice that I think in the past 10, 20 years, actually the industrial metal production has actually increased substantially. Aluminium, I think, production has actually doubled. And with the sharp decline in economic activity, one might actually ask, how high prices will go. So for now, I think we are relatively nuanced towards the prices for aluminium. I think one very key point to take a look at as well is the POTUS, the US election actually in November 3rd. I think it's something that you might want to take a look at. I think political rhetoric might be a key catalyst for the aluminium market. We have seen prices move quite aggressively during the pre-US-China trade tariffs when they threatened that portion. Prices are quite volatile. So once again, why is the US-China trade tariffs an important indicator, or why does it have huge impact on aluminum prices? You can look. So aluminum production by region, China has a huge market share, and consumption itself, China itself has also a huge market share. Henceforth, it's actually very similar as per copper, whereas Chinese economic indicators and transport, packaging, construction, all these are industries that consume aluminium. All these are actually has huge impact on prices. Market supply for now, I think supply is still relatively tight. The spot supplies in the market, low inventories we see in China, I think it helps to support the prices for the current term. So I think on the geopolitical end, I think this is quite important. This is something that might move prices or shift prices as we move forward. KPIs like this similar, I think it's the same. You have the Commitment of Traders report, economic indicators, etc. I'll not touch too much on this. So next we'll move on to zinc. So this is a brief comparison, I think, on the for the global between the three global exchange. Basically, as I said, red is the Hong Kong exchange actually contract. In blue, we have the SHFE zinc futures, and yellow is the LME. So roughly, we see the price action is this, as I shown earlier, right? It's the same, relatively similar, not much difference. You can see the weak PMIs and Asian GDP growth, and actually the coronavirus-led concern. This is actually deemed the outlook for zinc. Our view is still, I think that zinc prices look like to be quite range bound. I think that prices actually peaked in January because of the signing of the phase one trade deal. But however, I think after the numerous factory shutdown, as I mentioned, and quarantines in China, I think demand is still relatively constrained. Zinc inventories still remain on the rise, as seen from the positions. But however, I think with the pickup in construction activities over here, and also with the coronavirus tapering down in China, we should see increasing demand for steel, although steel prices are still quite depressed. That's why we see a slight build-up in prices over here. So if we look, I think moving forward, I would say that zinc prices, I do not foresee them to actually move upwards very strongly. I think we still remain at on a gradual downtrend probably because as production shifts due to surplus. But I think you should actually take, once again, geopolitical factors and the economic uncertainty might push prices up aggressively. You need to be very aware of this. So once again, the fundamentals, I summarize some small little page, some key points. Auto production, I think galvanized steel, construction infrastructure, these are the key things that will affect prices. If you look at the zinc mine production and usage, right, you realize that a very strong component is still Asia. The three commodities that we spoke about is still very driven by Asia, little by Europe. So the reopening of factories have actually boosted market optimism, but most Western zinc producers have actually curbed the mining activities to manage the COVID-19 concerns. Next, we look a bit at nickel. For nickel, lead, and tin, I'll just go through briefly. I'll not talk so much about this, the three commodities. So this actually, I think, is largely electric vehicle and stainless steel sector. It's driven by these two sectors. So the stainless steel sector, right, is of course one of the biggest sector for nickel. Whereas for the EV, these are something that is very, people like to trade the prices. So there's no Tesla. Tesla is one of the big proponents of EV. So this is taken 3 days ago, the slide. But if you see the current nickel prices has been shooting up a bit, thanks to the tweet from Elon Musk. So we predict that the strong and demand of this, right? Actually, the strong demand of the EV industry and stainless steel actually drove the bullish outlook. It drove prices up to 19,000 in the LME. So yeah, as move forward, and of course nickel, which after this is due to the coronavirus-led concerns. We believe that ESG policies are likely to drive the nickel price story. Nickel use in EV batteries are already forecast to grow significantly over the next 10 years as we move more into less dependent on fuels and more into renewable energy. So even with non-stainless applications, I think many are predicting that there will be a sustained strong growth in consumption on nickel for electric vehicles and energy storage. So all this, I think, is likely to boost prices in the longer run for nickel. However, we notice also there's actually quite a significant underinvestment in the sector, and stocks are quite low. So that's why I think in the longer term, we are quite bullish on nickel. However, in the short term, you need to take a look at the current sentiment, which is not very positive because of COVID. If we look at lead, for example, I think we still see some softness in prices over the long run. It's largely the same as all base metals. You see a peak up to October before a decline all the way into the second quarter of 2020. So I think the ongoing trade war, of course, is one of them. Soft PMIs, as I spoke earlier on, for many of the industrial metals actually push prices. Of course, China, which is the world's largest producer and consumer of lead, and we saw weaker than expected growth and slow expansion in construction activity. All this actually accumulated and actually slow prices. However, we do see some recovery in lead prices, but I think the lackluster lead demand in China and also the broader slowdown in economic growth will actually keep prices contained. It's likely to remain, I think, range bound, even though that there's some upside price risk due to the Western producers having production problems. So I think, you know, if you might have some new headline trading activities that might happen, but however, in the longer term, right, I believe that you should look at the automotive industry and global production. This is likely to swing prices in the near future. If you look at tin, for example, the last of these 6 base metals, you will notice that actually prices are actually it's a sharp decline over here before I think it bounced back. It's actually recovered back to pre-2019 highs. We think that the world consumption of tin has declined actually since 2015. Demand, I think, is still extremely subdued. I think we need to pay attention to global production here, where China, Indonesia, I think accounts for 50%, while Peru, Bolivia, and Brazil accounts for the other 20%. So around half of tin's demand comes from solar applications and in consumer electronics. So this is something that you want to take a look. So if you look at GDP growth, consumer confidence, purchases, these are likely to dictate the price story for tin. Even as a global tin demand, although it looks like it's going to set to recover by 2021 due to the 5G networks, telecommunications, and electronics sectors, largely commercial largely commercial applications. We believe that short term, I think there's still some weakness. We don't expect prices to move too aggressively, but long term, I think the outlook for tin, like nickel, right, it still seems good as the emergence of commercial applications, smart home devices, are set to be on the rise. So as we look at all these, the 6 base metals, you'll notice that the prices move actually is due to a lot of industrial and commercial applications actually. So actually, how can we or investors actually trade off base metal contracts? So very simple. I think I put an example for outright play on contract. For example, if you see an upside potential in copper prices, so rather than going into the OTC, which is closed, or ETF market when it might take some time to respond, you decide to go long in copper futures. So I'll put an example. It would be the Hong Kong Exchange USD London Copper Mini Futures, the November contract, for example, if you enter on 10th August. So if you buy 5 contracts at the price of 6,500, the margin will be 2,220 times 5, which is 11,000. On 11 August, the next day, once the market opens, we assume that prices are trading at 6,520. So what you will have against your initial price is that you made a profit of $20 per ton. So an example of the illustration of your profit and loss will be $20 times 5, which is 5 because it's 5 tons per contract, which is $100, and you get 5 contracts times 100, you get a $500 profit. So this is a way, I mean, this is excluding brokerage charges once again, but this is a way that actually some people speculate or rather trade off the price action for base metals. But do note, of course, the risk and reward is in tandem. Both profit and loss is the same. So over here, I've done a little, I think just a very simple introduction, right, on technical analysis. How some traders actually, their preference is more on technical analysis. Intraday trading, it depends. So for this, right, I pulled off a longer time frame, a weekly candlestick continuous chart of Bloomberg on the LME 3-month rolling forward. As an example, you can see that actually, right, I put up the Fibonacci over the last 5 years. You can see that actually prices, right, tend to mean revert and respect levels. So as you can see, right, like for example, in the latest price point for copper especially, right, we see some weakness over here. The appearance of a doji candlestick started to weaken. If the continuation of the bearish trend, I think scenario, right, if it actually breaks, I think the next level that it might retrace, it might be the 6,600 level. Sorry, I mean the 6,190 level, like 6,200. If we see a sustained break, right, we might go all the way down over here. So of course we can see that some support levels has been noticed. So I think largely, for copper futures, I think just like the other futures contract, we see gold, silver, and the rest. It's still the idea and the concept behind technical analysis. I think we do see it still happening. Like you can see over here as well. See some strong support over here in the 5 years low. Yep. So for aluminium, I think it's largely similar. I think you can see it's trending upwards. You can see it respects the levels. Not much of a difference. I think it's just come off actually the 5-year low I think it's trying to see it actually revisiting and retesting the key resistance level about 1,737. So once again, this is a weekly time frame. You know, if you guys are doing intraday trading, maybe you might want to use moving averages, RSI, to help you, or even actually look at the candlestick action for determinant. I think I'll go through more on technical analysis probably in the next series. I'll go through more intra-market spreads and also outright trading. So this is actually just to give you an example of how some traders, right, who participate in the market, they take advantage of the price action that they wish to speculate. Whereas for zinc futures, I think copper was more predominant. Zinc futures, I think it shows there's some, actually it respects the levels to a certain extent. We can see over here support is being seen over here, but repeated testing before it move down. So I think zinc also is at the stage where it's actually testing a major resistance level that is about, I think, 2,266. If it breaks out, you know, it might actually move higher as it retested this level several times, as you can see over here. Did we see some rejection here? So I think there's some support, there's some degree of support over here. This is where zinc prices is. Okay, so as we talk about as to sum up, I think my presentation, key product development. So actually, how can we discover base metal prices in 2020? So as I spoke to you earlier on, we have the LME for base metals, of course, the world's industry benchmark. We have COMEX, which has copper, we have SHFE, who has all 6 as well, which is SHFE is the Shanghai Futures Exchange, but the SHFE is still largely domestic. So I think I wish to direct your attention, I think, to the Hong Kong Exchange USD London Base Metal Minis Futures Contract. So this was launched in actually 2019. It's actually a mini contract, futurized contract. So we can see that the asset class actually shares the same asset class as, because they follow the same settlement price and underlying asset as the LME contract. That's why prices move in tandem. The contract size is 5 tons for each of them. Each prices are priced by ton. So nickel and tin is about 1 ton. Currency denomination in US dollars. It has 12 calendar months. Normally you see the active months, right, is from the spot to the 3rd month or 4th month. The 3rd month is the most active month actually. A tick size is about 50 cents for copper, lead, zinc, and aluminum. And of course $1 for nickel and tin. There are 2 sessions actually, the day session and the night session. So you can actually visit prices in Asian hours. And also if you wish to take advantage of London hours, right, against the LME benchmark, is something that you can look at. The last trading day is 2 London business days before the 3rd Wednesday. If it's not a Hong Kong business day, then it's the immediate day before the Hong Kong business day. So as I mentioned earlier, I think an important aspect to this is the final settlement price. This is actually the OSP determined by LME before the 3rd Wednesday of the spot month. Cash settled contract, so you need not worry about physical delivery. To sum it up in a nutshell, it's basically a standardized contract, a bit more simple to grasp. It's smaller in size, 1/5 the size of the LME contract, and it's denominated in US dollar. So I've summarized also some key points. So actually, why should actually traders actually approach the Hong Kong Exchange London Mini contract? So yep, as I said, mini contract size, 1/5. It allows traders to benefit from trading flexibility. For the hedges, right, if you enter into a smaller contract, you can actually choose it to hedge half LME, you know, and the loose denominations in the Hong Kong Exchange contract. It allows cash settlement. It allows you to settle against the LME OSP, avoid physical delivery, so you avoid getting squeezed if you're too late into the contract. Underlying asset is the same as the LME, which is the global metals benchmark, to actually hedge price risk. It is standardized. I think there's limited credit risk because of the central clearing counterparty system. There's standardized contract specs as well, so easier comprehension by our traders. Once again, Asian trading hours, both day and night session, that actually was created to complement London trading hours. Currency denomination, there are actually both USD and CNH contracts that you might want to look at. Arbitraging opportunities, you can actually arbitrage against the LME, COMEX, or SHFE. Actually, then it shows that this is an opportunity for both, I think, physical proprietary traders or retail investors, depending on how you take advantage of the situation. Okay, So I think before we move into the Q&A, I would just like to share that on this portion or this part of the webinar, I think it was designed to give you a brief outlook, introduction, basically base metal one-on-one, understand more about the different contracts and different applications we have for base metals. The next webinar will share more on like the price action, intra, how people trade. There might be a few, like for example, some traders will use outright technical indicators to trade the base metal contracts. There will be some who actually participates in intra-market spreads, where they will pay attention to the LME market, depending on the opening hours and also on SHFE to decide on the trading strategy. Then we will also go in probably to introduce a bit more on, besides base metals, we have the ferrous market. What are some of the new product developments? Yeah, so in a nutshell, I think if you have any inquiries, you can always email or call us, Phillip Futures. I think we actually offer all these contracts as a broker. You can actually email Commodities BD, which I'm part of the team here. I'll be happy to actually share more or even direct you to the right direction for if you wish to know more. The account opening link is over here, or QR code is over here. I think for some of our viewers who are in Malaysia or Thailand, you can actually approach your respective AEs or BDs. I think they'll be very happy to assist you. Yep. So I think that's about it from me for today. I think we'll move into Q&A. Sri, do you have anything for me?
All right, ladies and gentlemen, if you have any questions for our speaker for today, Mr. Benjamin Liu, and we'll pick up your questions from the question box. If you're looking for your question box, just look at your control panel. On the right side, somewhere at the bottom, you have this tab with questions in there. You can type in your questions and we'll pick them up very shortly.
Yeah, so actually,
we have, yeah.
Yes.
Go ahead.
I'm just reading. I'm looking at the questions, right? I think there's one question. Hi, will you
Go
be
ahead,
able
go
to
ahead.
share the
Yeah.
recording? Yeah. So I think, yeah, this is no issues. We will be uploading this onto the YouTube channel and also our page. So for those of you who have missed out or wish to revisit this topic, right, you can always view it again. But of course, you can actually just drop me a email or something. I'll respond to whatever questions that you have. No, not an issue. Sri, do you have anything?
All right, we have two questions coming up right now. The first one is on silver and gold. If you're game, the question is your view on silver versus gold prospects from fundamental and technical point of view.
Okay, I think if we look at silver and gold, right, for silver, it's largely still a very industrial metal. I think gold is the one that is very much in attention now because of the attention is on the central bank interest rates and also because of the fiscal stimuluses that are pursued over the world. I think today if we see, right, look at gold, the prices actually, I think there's a intraday volatility of between $40. So I think for those of you who are trading gold, what is most important, I think I'll approach it from a risk factor. The volatility, which is intraday, can easily take you out of your margin if you do not have enough cash equity when trading both futures or the spot market. So I think this is one thing that actually traders actually should look out for from a risk perspective. If you ask me the prices, I think it looks like it's about to challenge the 2000 mark from a technical perspective. I think a lot of we do see a lot of retail investors or actually speculators moving into gold at this point of view as prices actually just continue to shoot up. But once again, I'd like to reiterate my point that actually risk management is quite important. If you oversize your positions, right, you might not be able to actually achieve your intended results as you will get taken out on a low equity call, on a margin call, even before the price reaches its intended direction due to the volatility. And also for gold, right, I would say there are various places where you can actually participate. So Hong Kong Exchange is also an exchange that actually has gold and silver contracts, and silver is actually their latest inclusion. So this might be some of the different contracts that you might want to look at.
All right, Ben, we have another question, but before that, do you want to flash your contact details in case they have any other questions for you, they can get in touch with you? All right, the question is, for LME land, if it's related with automotive. So with COVID situation, the next 1 year, what will the demand be like? Will it be quite low?
I think for now, right, I think what we are looking is that the LME short-term prices are still very vulnerable. I think the lead market, right, still looks like it's in surplus. There's a general weakening in the global economy, as we notice the automotive and everything is still suffering. So I think that although now the primary pickup in prices, right, is due to the issues of the shutdowns in the smelters and some of the mines. So I think if we continue to see more production problems, right, and also more Chinese-led consumption on the base metal, right, we might see prices going up. However, I think in the longer term, right, like if you look actually back 2 years and 1 year, right, China has actually implemented much environmental controls. So I think this will will keep prices relatively range bound, and we still see a lot of headwinds in lead prices. So I think in the short term, right, what I think will actually affect prices is really very geopolitical, or even actually very macroeconomic. So I think news, actually headline trading is likely to actually push prices around, yeah, in the short run.
All right. The next question is slightly more general, but in terms for base metals trading, what do you think is a recommended chart indicator for someone who's starting out?
Recommended chart, okay, very technical, is it? I think for me, I like to, when I look at a longer time frame, I'll start off with a Fibonacci. I think I like to see the levels. I think it's quite to check if the contract actually the prices actually respect the levels. I think that's the start. I think some of the very common intraday traders, they like to use, maybe they might use a moving average to actually catch a reversion in prices, or even for Fibonacci, I think it's more of a breakout indicator. Some clients, I think they are met or day traders, they prefer to chase the trend. So I think this is something that you can look at. But I think once again, right, I think as I've said, right, I think risk management is very important. I think I cannot stress the importance of a stop loss. These are things that you have to take a look at. If it's purely speculative, right, and I think intraday trading, I think technical indicators can work, lah. Yeah, but you have to have, it's best to have a journal, a trading plan. Yeah.
All right, Ben, we are still waiting for the next question. In the meantime, I have a question for you. Amongst the base metals which you've discussed today, if there's one base metal that investors should look at very closely in the coming months, which do you think it is?
I think you can actually take a look at the copper, copper and aluminium. I think these are two contracts that you want to look at. For example, right, the copper contract in Hong Kong exchange, I think the liquidity is fairly decent. We have more than, I think, 500 or even close to 1,000, depending on traded volume. So this is something that I think that is huge. It's a metal that has a huge interest in the market, huge market interest. Even the aluminium contract, for example, right, it's extremely liquid, and it's actually the most liquid contract in the LME. I will discuss in further detail, right, in the second webinar, where we look at the volatility, the intraday volatility of the contract. Now that is very important, as it will tell you, right, the tick movement, and you can see, and from there you can devise a strategy and see how we can trade it. Copper, right, because of its widespread use in the industry, is very closely connected to macroeconomic events. So that's why also, some people, depending on your approach to the contract, you can actually is very well traded. So that's what I would say. I think copper and aluminium, I think it's actually one of the things that you can look at as traders, right? You can benefit from very tight spreads, deep order book, and a very long forward curve. Yep.
Okay, we don't have any other question, but can I just ask you one more? All right, we just received one. Okay, are there research done with charts correlating to various industries that use these base metals that you have presented? Would you say the demand aligns with the movement on the chart?
Okay, so yes, I would show you, right? I think I managed to put up one. Just a minute, let me just go backwards. Okay, just for example, the copper. So this is the SHFE Hong Kong Exchange London and London Mini Copper Futures. So the one in yellow you see, right? This is the Caixin Manufacturing PMI, the Purchasing Managers Manufacturing Index. So as you can see, right, there's a very sharp drop. Now notice that this is a historical and is a lagging economic indicator. So sometimes, right, you might not be able to catch the information beforehand, but it gives you a reflection, right, and a sentiment of prices. So once upon release, right, you can expect to have actually traders or actually look towards the Chinese actually PMIs or construction index monthly releases on economic release for an indication of price action. So you can see even when it was released in February, right? But in March, right, you can see that the movement still continues, as I think the market sentiment was very, very poor and people traded risk. I think it's a good point that you have mentioned. I think in the next webinar, right, I will put on more research to show the correlations between the economic indicators, right, against the price action for the base metal futures.
All right. On that note, Ben, would you be able to just give a very brief overview of what our viewers can hope to learn in the next session?
Yes. So I think in the next session, probably I'll start off with a little recap on prices. We'll talk more about. I'll give you some research on how the price actually correlates with some of the economic indicators. But I think more importantly, I would like to share more on the application, the trading strategies that we have. I'll go maybe a bit into outright technical analysis. I will do probably a little more on the intra-market and intermarket commodity spreads to show you how it is correlated and how actually traders can take advantage of this. So I think, and also I will give an idea of the base metal derivatives market and also the non-ferrous market to introduce maybe various products and to see actually how traders, you can actually approach these products and discover prices in 2020.
All right, we have one more question. What are the correlations between these base metals, and what are the correlations between these base metals, and would you achieve diversification by trading them?
Okay, so I think if you are talking about correlations for the different base metal contract, I think LME and Hong Kong Exchange definitely tracks one another extremely closely. That is because they have the same underlying asset and they share actually the Hong Kong Exchange base metal contract actually derives its official settlement price from the LME third Wednesday contract. That is one. If you look at a cross comparison between SHFE and the Hong Kong Exchange USD London copper contract, for example, right? Both have a very strong correlation as the SHFE contract actually reflects domestic demand, right? Whereas even internationally for international benchmark like LME and Hong Kong Exchange on copper, is still very reliant on China as a buyer. So with China's role, right, like which actually dominates like 50 or 60% of demand, this has actually a huge play on prices, and that's why we see a very strong correlation. I think for diversification, right, wise, if you're talking about the different contracts, I would say that I think SHFE is still very much closed. COMEX, you have copper, but if you were looking at aluminium or zinc, I think the only option that you have for now, it's more on the LME or Hong Kong Exchange. So the primary difference, right, is on the contract sizing and the fact that Hong Kong Exchange is a futures contract. I think the new developments, I think LME has been in the market for a long time. So I think for new developments, if you look at, I think what Hong Kong Exchange is trying to achieve is a Asian benchmark. So I think it's something that we can all look at. I think if you wish to achieve a certain level of diversification, I think in terms of product, right, on the product level, then yeah, this too probably is something that you would want to look at because they share the same underlying. But if you want to look at something that has a different underlying, for example, in terms of COMEX, right, then you have to look at copper, for example, then you have to look at COMEX then.
All right, thank you so much for being a wonderful audience. That's all the time we have for today. We will be sending a follow-up email to you, and you will have the link to the recording of this session. You will also have a link to register for the next webinar, so do look out for the email. All right. Thank you once again for tuning in, and that's all we have for today. Good night. Take care.
Okay, thank you so much, guys. Thank you so much.